And today I thought we would touch upon something that's very important when it comes to understanding investments, understanding how to trade, understanding different facets about it. So, so what we would be kind of touching upon today and understanding a bit more would be basically risk management. And and why this is very important is because a lot of the profits that you'd make in the market or a lot of the losses that you'd incur in the market would be very well tied to the amount of risks that you'd be taking. And it's always a good thing to measure that before you jump into investments. And one of the things that's very important is to understand yourself as to what is your risk appetite, right? Like I think we have discussed before, some people are more risky. They kind of have a good appetite of taking more risks in their lives. So for them, the kind of portfolio they would build, the kind of investments they would do would 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 be significantly different from, say, people who are not able to take so much risk in their lives. For them, the kind of investments that you do, the kind of bets that you take would be really different, would be absolutely 180 degrees, right? And why this is important is also the fact that it also depends on what kind of place you are in. Like, say, for example, if you are in a pension fund, right? You have to take a little bit lower risk because you are dealing with the lifetime earnings of people. So you want to be more responsible. So you want to be you want your bets to have less risk, right? Whereas, say, if you are a day trader, I think your risk appetite would be much more because you are like, yeah, that's what I do. I take risky bets, and sometimes it gives me a really good return, and sometimes it's not that good. But I wanted to tell you about a fund, about I'll not name that person, but I met this fund manager who was a fund manager uh, in the early 2000s, and what he had done is like uh, around 2006, 2007, he started getting a decent understanding of the subprime market, right? As to like what was going on. And and he was a fund manager where the LPs, who are limited partners, who actually put in funds for you to invest. The LPs were basically these pension funds, the teacher funds, so really low risk. But um, but what he thought was that the risk wasn't that high because there was some error in his calculation. So the risk wasn't coming up to be so high. And that's why he put in a lot of money into the real estate bonds, which we all know again crashed during the 2008, 2009 crash. And not only that, the fund closed down, but a lot of people, a lot of really hardworking Americans across the United States lost a lot of money. That's why you have to understand why risk management is so important, because you're dealing with the future of people. You're dealing with the lifetime earnings of people. You're dealing with 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 families, right? So so while investing, just don't think about the fact that you are just investing and that you are just an investor. Think about the people whose money you are investing. Think about what's their risk appetite, what's the kind of people you are dealing with, right? And that's very important. So let's get started. As you guys already know, my name is Anomitra Banerjee. I'm a recent Wharton MBA grad. I majored in finance and strategic management. And currently I look at strategy, investments, and corporate development at Amazon. Uh, yeah, that's my background in a nutshell. And let's get started. Coco, could you enable screen sharing for me? Great. Uh, so today we're gonna just touch upon and learn a bit about how we are gonna manage our risks in our investment portfolio that we have. A lot of you guys are in the stock track competition. A lot of you guys are in the gym, which is a global youth meetup. And a lot of you guys are dealing with building your own portfolios and investing. So this will help you to understand how you can manage your risks while you are in this game. So let's start with the understanding about why do we want to manage risks, right? Like, why is it so important? Now, you have to understand that the fact is that the risk is a definite and very important part of investing. And the way you manage it is very crucial for you to achieve your goals. Like, for example, your risks would be significantly different if you are investing, say, for a timeline of 5 years versus if you're investing for a timeline of 10 years versus if you're investing for a timeline of a day. So the risk could vary very differently. So if you are not managing it properly and if the risks are not mitigated properly, it can lead to significant losses, and it would really, really, uh, you know, embarred you from reaching your financial objectives, reaching your goals as an investor. But whereas if you manage risks properly, if you identify, assess, and control the risks, uh, it will make you a much more disciplined investor. It'll create much more disciplined investment decisions, which will lead to much better profits or much better outcome for your investments than you could have had you not had risk management. So by incorporating these strategies, by incorporating what we are going to discuss today, you can potentially optimize your returns, and you could also like kind of hedge your bets. So basically, it says that in some asset classes you'd be taking much more risk than you'd want to take. Now you'll offset that with another asset class where the risk profile would be less. So basically the risk would be of the entire portfolio, right? So you'd be like, okay, if I'm going to lose some money over there, I'm definitely sure that I'm going to earn the money over here, and that would balance me to get my desired, say, 6% return, 10% return, or 14% return for my entire portfolio. And try to understand this, that risk management is not something that occurs, say, once while you're investing. It's a continuous process. It's a process that requires you to to do it in an ongoing manner, monitor and adapt to the changing markets and the different environments, right? Like, say, for example, even elections, they're a risk. You don't know. So how do you optimize for that? Say, what if, God forbid, a war breaks out tomorrow? How do you build that into your portfolio, right? So that all of these external conditions have very less impact on your investments, and you are very well suited to get the outcome that you desire. So the kind of investment risks that we kind of will look at today, and which are the most important one, are of like four types. One is market risk, then there is a credit risk, a liquidity risk, and an operational risk. Now, I'll just touch upon these four to make you understand what they really mean. Now, let's start with, say, the market risk, right? The market risk is basically uh, the risk that the market has on your portfolio, right? Like, say, for example, say investor sentiment changes about, say, a sector, about say defense, and suddenly people are selling. So you'd be in some losses, right? Or like say some country devalues their currency and suddenly the currency exchange rates have gone for a toss. So you'd incur a loss, right? So these are market risks which are played out by the market. And you have to understand like how you are best suited to mitigate these risks. The second would be credit risk. I think the risk that as a borrower may fail to make required payments, right? Like say, for example, um, say you bought a bond, right? We learned about bonds, right, over the first four of my workshops. So you buy a bond of, say, company XYZ, and then they falter on paying the required payments to you. Now that's a risk that you have to take, right? Like, for example, think about what is the risk involved, or what is the probability involved that this company XYZ would be bankrupt before they can actually pay out their bonds. So that's basically something that would build into your credit risk. The third would be liquidity risk. This is like the risk that an investor may not be able to buy or sell an investment quickly, right? Like say, for example, uh, say you have invested in, say, 5 stocks, right? And you really don't want to exit them because you know that those stocks are going to rise over the next, say, 5 months or 2 months. So you don't really want to exit those investments right now. And the latter part of your money is, say, into real estate or somewhere else where it's illiquid. Then how do you get that money? Now that's a liquidity risk. So you could make a trade that could make you a lot of money, but now because you are out of cash to put into the market, you just couldn't realize that profit, right? So that's a liquidity risk that any investor might have. And the last one is an operational risk, basically the risk of potential losses from, say, failed internal processes or, say, human errors, right? Like, say, for example, again, you are really plugged into the automobile sector and you make a huge investment into, say, any of the car companies, say XYZ, say Ford or Chrysler or Tesla, any one of them. And say due to some internal processes or some human errors, they've created faulty cars. And now they have to call back all of these cars. That's basically the what can absolutely go wrong. So an operational risk where the stock price would absolutely get a beating because they had to call back all their cars which they had already sent out to be sold, right? So those are some operational risks that you have to also build into your portfolio. And apart from that, say trading errors, right? Like for example, you while executing a buy order, the decimal point just moved here and there. And that would create an enormous amount of losses, right? So these are kind of operational risks that you have to build into your portfolio. So when we talk about these financial risks, let's think about the potential impact that each of these risks can have on your portfolio, right? Uh, say market risk. Well, a significant market downturn can absolutely erode your profits, right? It can put you into losses. Uh, can get you on the red side of things, right? A credit risk could be like, say you put in $10,000 on a bond and they declared bankruptcy and now can no longer pay you as a pay you need, like, just put aside the interest payments, like they can't even pay you back your principal, right? Now that's a credit risk. That's the impact that you might have. Liquidity would be like you can be forced to accept a lower price to sell an illiquid asset quickly, where you have to create a loss, have to take on a loss because you need that cash to, say, invest in something new, right? And we talked about operational risk, like say about like a cybersecurity breach, which would take the stocks that you have invested in to lows that you have not seen before. Yeah, so these are the kind of risks that might have a huge impact all of your trades. So how do we measure this risk, right? Like, so when we talk about risk, I think the natural question that you guys would have at this point of time would be, okay, we understand there's risk, but how do we actually measure this risk, or how do we actually think about these risks? So when you think about risk management, you can actually think in two terms, right? Like, one is the quantitative aspect of risk, and then there's the qualitative aspect of risk. And we're going to talk about both the things, right? We're going to talk about how to measure risk in quantitative terms, and then we're also going to talk about how to measure risk in the qualitative terms, right? Like, I'll give you certain examples when we reach there. But when it comes to quantitative measure of risk, there are actually a few ways that you can absolutely measure risk. One is definitely standard deviation. Then the other one is beta, and the other one is value at risk. These three are mostly the most important ones. Now, when I talk about standard deviation, most of you guys would know, right? Like, I think every one of you know, you guys are all seniors now, mostly. That it's a measure of dispersion of returns from the average, right? Like, say, for example, if an investment has an average return of 8% and say a standard deviation of, like, say 15%, well, it means that 68% of the time the returns will fall into a range from -7% to 23%, right? So with different asset classes that you would invest in, right, you'd have different average returns for them. So, and when you have these average returns, you just, like, the Excel function that is like equals to STD, right? So standard deviation. So when you put in that formula, it will actually give you the standard deviation of all the returns from your portfolio. And the standard deviation would actually tell you, like, what the return range can fall in, like, from it can go to what, like the highest return to the lowest return, right? And then you might be much more better suited to understand, okay, for the highs are always good, right? Like, you'd never be have any problems with the highs, but then are you being able to take the lows? And so you can adjust your portfolio accordingly. If, like, say, for example, no, I cannot take a -7% on my portfolio, you change some of your investments to take the returns to fall between, say, 1% to 20%, or say 2% to 20%. So that you know that even if everything goes wrong, I'd still have a 2% return on my portfolio. So that is one way of kind of measuring risk quantitatively. The other is the beta. The beta is nothing but a measure of an investment's volatility related to the overall market. So it represents kind of the tendency of the investment's return to respond to movements in the broader market. Like, and I think I was teaching this to the folks in the class the other day. Like, if a stock has a beta of 1.2, it means that it is expected to be 20% more volatile than the market. And the volatility of the market you can get from any of these sites like Google Finance, Yahoo Finance. We will tell you that, okay, the market today is like X% volatile, like, which means that the market might go up 5% or go down 7%, right? So when you know that today the market can go up 5% or go down 7%, and your stock has a beta of, like, say 1.4, it means that they're 40% more volatile than the market itself. So say if the market can go up 5%, which means that the stock that you are trading in can go up 5% plus 40% of 5%, right? Which is like another, what, 2%, right? So you can absolutely get an understanding of the stock that you're investing in, that through the beta, as to, like, how it's gonna play out given the broader market conditions, right? Like, say, for example, the market responds to a variety of things, right? Like, say, for example, the market responds to supply chain demands. Say, when the Suez Canal got blocked up, right? The market responded, the stocks fell, right? Because people are not being able to sell. So the market will respond to a variety of things, and the beta is like a very good measure to understand the volatility of the stock that you're investing in with respect to the market. And then we have the value at risk, which normally in the finance world, we call as VAR. So VAR is nothing but a statistical measure which kind of estimates the maximum potential loss of an investment or portfolio could experience at a normal confidence level. Again, this is more of statistics. But given an example, if say the one-day VAR of a portfolios is $100,000 at a 95% confidence level, it means that there's a 5% chance of losing more than $100,000 over the next day, right? So it's kind of based on historical data. When you look at the historical data, you'd understand how your portfolio would be doing the next day. So like, for example, if your portfolio has like, say, 10 stocks, what normally people do is they look at how the 10 stocks have done over, say, a 3-month period, a 6-month period, a 2-year period, a 5-year period, and then they would create a statistical model out of it where they would say that at this confidence level, the VAR of the portfolio is X amount. So I think that's one other way you can quantitatively measure risk, which is like, okay, can I take the risk of losing $100,000 over the next day? And if you can, then you just need to go back and rejig your portfolio so that the VAR is quite different from what it is now, right? Now let's come to the qualitative aspect of risk. And this is very interesting, like, because the quantitative aspect is something that all of us understand. It's pure math based on like statistics. It's easy to calculate. People have been doing it for a very long time. And most institutions do it. So it's quite natural, it's quite intuitive. But what about the qualitative aspect of risk management, right? I think that's what matters. So I would say the qualitative aspect of risk factor involves basically anything which is not numerical, right? And those would be economic and political conditions. What are, say, the regulatory challenges or changes that's happening, right? We talk about, say, the management quality and corporate governance in the company that you're investing in. What about, say, the supply chain and operational risks? What about the ESG factors, right? So when we talk about the qualitative measure of risk, we would basically talk about, say, what is the economic and political conditions, right? Like, say, for example, say, if a country is at war, right? What happens then? What are the political conditions of doing business in that country, right? So these are the questions that you need to ask, and then ascertain the value of risk that you would give for that, right? Like, say, for example, say, let's take a country. Let's take Djibouti. Perfect country, absolutely great country, right? But it is surrounded by countries which are always in a civil war, right? Like, say, for example, Somalia, right? So how would you perceive the risk of doing business in Djibouti, right? What would be the overall risk factor for that country, right? So what you're doing is basically considering the potential impact of say, change in government policies, about political instability, about global trade tensions. So you'd basically take them into factor while understanding the measure of risk that comes out of that, right? Like, say, for example, say, what is one thing that affects the world, right? Like, so the world runs on trade routes, right? And what if there are pirates attacking ships? So basically, a lot of stuff is never going to reach the place it was intended to reach, which would largely affect trade, which would largely affect economic growth. So these are kind of economic and political conditions that you need to think about when thinking about qualitative risk. The second would be regulatory challenges, right? The regulatory landscape is always changing, right? There are new rules, new regulations, new laws coming into place. And say any new frontier, people are rushing to make regulatory changes in that, right? Like, say, for example, artificial intelligence. The US is working day and night to establish parameters, establish rules and regulations on AI, right? And what does these changes kind of tell you, right? Like, say, for example, some of these changes might benefit a singular company. Some of these might not benefit another company, right? So you have to always understand about these regulatory changes and think about who is it gonna affect the most, and if it's in a positive way or a negative way. You have to consider factors like, say, environmental regulations, like, say, tax policies. Consider factors such as industry-specific regulations, right? When you are thinking around these things. The third thing is about management quality and corporate governance, right? Like, again, for lack of better example, we do not want to invest in Enron, right? We all know what happened with that company. So, so think about what's the reputation, what's of well, how does the decision-making abilities of the company's management team look like? How much responsible are these guys? How much ethical are these guys, right? So you have to evaluate the effectiveness of not only the management team, but also the board of directors. What are the corporate governance practices? Because you don't want to put your money into a company which is gonna be caught in some fraud, and then your entire money that you have invested goes for a toss, right? You have to also understand if the board of directors and the management team is working to working to kind of behold the interests of the shareholders, right? Because at the end of the day, as a shareholder, you are one of the owners of the company, right? And that's why you also have a say. The fourth qualitative measure of risk could be supply chain and operational risk, like we talked about. Like, what are the supply chain dependencies? What are the geographical concentrations? Like, what is flowing from where? Like, say, for example, when I think about, say, Amazon, right? And Amazon doing its Prime Day, yeah. What is it that they're selling the most on Prime Day, and where is it coming from? Like, say, for example, if they're selling a lot of Samsung TVs, right? If that is their most sold thing, then we know that the Samsung TVs are more or less coming in from South Korea. So we understand, okay, this is how the supply chain looks like. So the TVs are going to be packed, put on a ship from South Korea to the United States, and it's going to come from this route. And then we are going to understand what are the dependencies out there, what are the vulnerabilities out there, right? What are the things that can get disrupted? So these are some things that you should look for when you're thinking of supply chain operational risks. And lastly, ESG factors. I think we need to assess the company's performances and practices on, like, say, environmental sustainability, like, say, social responsibility, and, like, say, corporate governance. I think we have to evaluate potential reputational risks or opportunities with these ESG factors. I think the last part was that till now we have spoken about what are risks, right? What are the two kinds by which you can think about risks? So there's this qualitative part that we spoke about, and then we have the quantitative part that we spoke about. But what about the strategies for mitigating risk? Like, because once you understand, okay, this is the risk that I'm looking at, how do you make sure that you have the perfect strategy in place to mitigate these risks, right? And the answer is, of course, diversification, right? So within diversification, there are a few things that you could do, right? Like, one of them is asset allocation. So you spread your investments across different asset classes, which can kind of mitigate risk through diversification, right? So don't put all your money into stocks. What about tomorrow, say the market crashes? You should know your risks and put your investments into stocks, into bonds, into real estate, and everything else, right? So like an example is a portfolio with say about 60% stock and 40% bonds may have lower risk than an all stock portfolio. So that is one way of kind of diversifying and mitigating risk. The second would be geographic diversification, right? Like, say, for example, people based out of the United States. Don't put all your money into into United States. Don't put all your money into, or don't build your portfolio on just say US stocks. There are different exchanges you can buy stocks from, right? Like there's NYSE, which is based out of New York. There's the London Stock Exchange. There's a Hong Kong Stock Exchange. So diversify by geography and buy stocks in every market, because although these markets are linked to each other, but different markets are not perfectly correlated. So you'd reduce your risks dramatically if you do that, because different markets have different companies which are kind of playing in different markets, which will not always kind of behave the same way as the other markets. Like US market would behave quite differently from the Europe market, which would again be very different from the emerging markets, right? Like, for example, US fluctuations wouldn't really fluctuate the emerging markets. Like Hong Kong would be quite shielded, even if, say, the US stock market tanks. So this is geographic diversification is one way you could also mitigate risk through diversification. The third would be to do a sector diversification, right? Like invest across different sectors can help you mitigate industry specific risks. So like, think about it, a portfolio with, say, defensive stocks like consumer staples, and also cyclical stocks like, say, industrials would be much better during market cycles, because like anything else, markets also go through cycles, right? Like, for example, when corn is getting harvested, you want to invest in companies which are using that corn, because the market is gonna open up for them, right? So I think sector diversification is also another way you can mitigate risk through diversification. And I think the last one, which is very important, I think apart from diversification, is hedging, right? So, and I've been talking about this a lot. So hedging involves basically taking an offsetting position to reduce the risk of some adverse price movements in an asset or portfolio, right? Say you could invest in options, you could invest in futures, you could invest in uncorrelated assets. But there are 5 main hedging strategies, like the first is forward contracts, the second is futures and options, third is safe haven assets, fourth is pair trading, and the fifth is government bonds. So these are kind of some of the strategies that you might use to hedge your bets. So when you're taking one bet somewhere else, you might take another bet in, say, the options or futures to kind of shield the other bet, right? So hedging is one very important way to mitigate risks. The third important way of mitigating risk is to have stop loss orders, right? And I have a very important story to tell here. So one of the stocks that I had invested in, and without any names, so I had forgotten to put a stop loss order. And at that point of time, I was outside the United States and the stock was in the United States. And as you might understand, when the market was working here, I was sleeping way back. And because I did not have a stop loss order, the stock went down and down and down. And by the time I woke up and I actually looked at my portfolio, I was in tremendous losses. So one of the very important way to mitigate risk is to always have stop loss orders. Now, what is a stop loss order? A stop loss order is basically saying that, okay, I bought the stock for $100. I want that if the stock falls below $95 or below $90, the entire stock should be sold out. That's a stop loss order. So stop loss orders helps investors by managing their risks by automatically exiting that position. So because I had a position and I did not have a stop loss order, the position was still there and the loss was huge. But if I had a stop loss order, they would have exited me out of that position while I was sleeping, and I would be shielded from incurring a huge loss. So you have to understand what's your sweet spot and set a stop loss order at that point. For most people, that's around 10%, but it can be anything for you. So for me, it's somewhere around 12%. So normally, if I'm buying a stock at $100, I kind of put a stop loss order at $88. So if the stock breaches 88, automatically all my stocks would be kind of sold out. And like I wouldn't go beyond that. So the amount of loss that I would take is not more than 12% of my entire portfolio. And that's very important. This is something that can absolutely change your life, because not having this changed mine for sure. I wish I had put that stop loss order that day. And lastly, I think it's about having a risk management plan. You should develop a risk management plan. It's a plan which is a comprehensive strategy which identifies, assesses, and mitigates various risks that you might have. So the few key steps that's going to be helpful in creating this plan is: what's your investment objective? What's your risk tolerance levels? What are your potential risks in the, like, for example, think about when you're buying something, think about what's the market risk on this, what's the credit risk on this, what's the liquidity risk on this, what's the operational risk on this. Analyzing and quantifying the potential impact of each risk, and then selecting appropriate risk management strategies that we spoke about on whatever you're buying. And then absolutely the second thing would be monitoring and adjusting the plan. So like I said when I started today, that risk management is an ongoing process. It's not that I do it once and I forget it forever, because the market is continuously changing. What the market was yesterday is not what the market is today, and it's not what the market will be tomorrow, right? Market is constantly changing, and that's why your risk management plan needs to change with the market at all points. So you have to constantly monitor your investments, constantly monitor your portfolio. And monitoring involves like tracking your performance and risk matrix, like what's the volatility looks like, what's the VAR looking like, right? Analyzing changes in market conditions, what's new information. Okay, say elections in the US, how does that look like? What does the poll says? Exit poll says? Who's leading? Why are they leading? So I think these are very important. I think reassessing investment assumptions and risk tolerance levels are very important. And if necessary, the risk management plan should be adjusted to address new or emerging risks or shift in these market dynamics.